Hi, my name is Dowling Yahnke. I'm the CEO and co-founder of Dowling Yahnke. I've got with me today Will Beamer, our President and Chief Investment Officer. It's been a little over a month since we've given an update, so we thought it would be a good time to talk a little bit about what's going on in the economy and the stock market. So we'll start off with a couple of slides here. We have a slide that shows what's happened since about March 23rd. So you may ask, why March 23rd? That was the low point of this market after hitting market highs in February. The market hit a low point on Monday, March 23rd. And I will tell you, a lot of this relates to the economy and people's emotions. So it was a low point in the stock market on the 23rd, and you can see what has happened with the jobless claims since March 23rd through May 18th, or I'm sorry, through May 9th. The jobless claims have gone from under 5 million up to 36 million, an unprecedented jump in the unemployment rate. And what we want, the message we're trying to give here is that when you look at how bad things are on the employment side and on the economy, look what the stock market has done since March 23rd through May 18th. The stock market during this period of massive unemployment and a contracting economy is up 32% from its low point, which is down, I think, a little bit over 35% from the February highs to March 23rd. So it gets to the point when people react emotionally about markets, they tend to make not great decisions. And so there was nothing optimistic that happened on March 23rd that would cause the market to shoot up, other than the Federal Reserve's, the monetary and the fiscal policy that put a lot of liquidity into the market. You can see the stock market has jumped almost by a third. So with there were a lot of nervous phone calls on March 20th, Friday, and March 23rd and Monday. You can see what's happened in the stock market. And this is when we see times like this isn't the only time that's happened. We have a slide here from 2009 that shows a very, very similar situation. So if you look at the slide back in 2009, you can see that unemployment, although not as bad then as it is today, jumped dramatically from March in 2009 through the end of the year. The market really started going bad in the fall of 2008. It hit its low point on March 9th of 2009. So again, there was nothing good going on in the economy in March of 2009, and the rest of 2009 was bad in the economy. So you can see that unemployment jumped greatly, and the stock market from March 9th of 2009 through the end of the year was up 67%. No clients called on March 9th, by the way, and said, I'm feeling good about the market. So what we want to get people to do is not tie what's the economy. When we get measurements in the economy, that's looks back in the past. The stock market's always looking forward. What's going to happen going forward? Nobody knows in these circumstances with a pandemic what's going to happen over the next 6 to 9 months. But at least since March 23rd, the market has said things are eventually going to get better. We'll get over this. And the market then has reacted and shows what it thinks is going to happen over the next 6, 12, 18 months. So these are two good examples of when the economy looks really bad, but the stock market doesn't move in lockstep. So again, this relates back to people's emotions. You know, when the economy is bad, people feel bad. Don't tie that directly to the market. These are two examples of extreme times when the economy is really bad and the stock market does really well. So with that, I'm going to pass it over to our president, Will Beamer, who will talk about interest rates and what's happened recently in that market. Will?
Thanks, Dale. Yeah, I think that's a really important point that you make, but I think we've gotten a lot of phone calls, and certainly a lot of ink has been spilled in the media, sort of mystified as to how the stock market can be going up so dramatically when the economic news, well, really the economic news is the economy has largely been shut down in many ways, and that sort of disconnect is very disconcerting to a lot of people. But I think, showing that that's not unprecedented, and it's actually happened before, obviously with different circumstances, but it's not unprecedented. Interest rates is another thing that we've had a lot of inquiries about. If you look at what's happened with interest rates, and I'm just going to use the 10-year Treasury and the 2-year Treasury as proxies for interest rates on this slide. We started the year on the 10-year rate a little under 2%. We're now at about 0.75%. So probably about a 60% decline in terms of the absolute rate on a 10-year Treasury. Two things really have driven that. The first is when you have a massive sell-off in the stock market, a lot of that money finds its way into the safest securities. This is sometimes called a flight to quality or a flight to safety. And so when people sell their stocks and other risky assets and they buy treasury bonds, that pushes the price of those treasury bonds up and it pushes their yields down. And so when you look at what happened to yields from, say the first of the year through early January, I'm sorry, through early March, we got down almost to 0.5% on the 10-year Treasury. We've sort of stabilized since then at about 0.75% for the time being. You might ask, well, the stock market's rebounded, and I would think that would mean that people would be selling those bonds and rates would be going back up. There's still a lot of fear out there. And then I think the other thing, and this gets to the second part of this equation, is we've had unprecedented amounts of stimulus that have been injected into the system by the Treasury and the Federal Reserve. And so, the Federal Reserve is buying bonds left and right. And because they are really have a virtually unlimited checkbook, that has continued to sort of suppress those interest rates. Some people are asking about, would we ever have negative interest rates, sort of like Japan and many parts of Western Europe have experienced over the last few years. Certainly nothing's impossible, although Jerome Powell at the Federal Reserve has expressed that, he does not see that on the policy horizon. He does not see that as something a direction that they currently are thinking that they want to go. One other thing I want to address on this slide, if you look on the chart on the right, the black line shows the decline in the stock market that really began in earnest in late February and accelerated through the third week in March. And then the blue line shows your return on a high quality intermediate term bond index. And the key message here is that during this period of time, high quality bonds have done exactly what they're designed to do within portfolios. They have been the ballast. They have maintained value. And over the year to date, they're up about 3.2% with very little volatility. There were some slightly shaky for the bond market moments in mid to late March, where there were some liquidity concerns. But overall, if you compare the volatility of the blue line to the black line, you can see that bonds have really done their job and been that safety part of the portfolio. With that, I want to turn just to talking a little bit about Dowling Yahnke and what our current status and what we see on the fairly near-term horizon. All of our employees continue to operate 100% remotely. We talked in our last update about how pleased we were with the fact that we had made preparations to have everybody equipped and ready to kind of work from home, and that really was a pretty seamless process. Our business continuity committee is now back convening on a weekly, sometimes more frequent basis, looking at all options for how we can safely return to the office and get back to a more normal working environment. We're paying close attention to all of the governmental agencies and public health folks that are sort of providing guidelines and regulations around how we can execute on that. And safety and well-being of clients and employees are our absolute top priority. So we are not going to rush this process. We anticipate we'll probably have a handful of folks in the office at some point in June, and then be looking to make preparations to bring a broader swath of our employees back into the office later in the summer. So that's kind of the quick update on the firm. I'd say the biggest thing missing is our face-to-face interaction with clients and with each other. We all sit in on a lot of online meetings, whether it's Microsoft Teams or Zoom, but we certainly miss the in-person interaction that we all sort of thrive on. So, Dale, anything to add?
No, Will, thanks. I think you said it great. And, safety is number one for both our employees and our clients. With that said, I like Will, we miss the interaction, we miss the camaraderie, we miss the synergies that come from being together. But I also say we've learned a lot. Our technology and it continues to improve, and these are new things that we've learned about meetings and communication. I think we're in the communication and the relationship business, and it's our job to communicate well with our clients. So, and any feedback from clients that are there different ways they'd like to communicate, we're open to it. We're trying to have phone calls, emails, but our goal is to get back in the office eventually, and we look forward to seeing you all. So stay safe. Thank you for listening, and we will have another one in the future, but thank you very much and have a great day.